Good afternoon. It is July 28th, 2021. We hope that you are enjoying your summer. We're trying to as well, and we're trying to get back to some kind of new normal, right? I think we're all kind of doing the same thing. Seth and I believe me, we're in the office. We're in our respective offices just because the sound quality is much better. But we are so happy to be done with all the plexiglass. No plexiglass in the offices at all. There's remnants of it. We've still got it on the floor in case somebody comes in and they want us to put it back up again. But even to kind of walk out front and see nothing on Nicole's desk, which she's in the front lines of the office. It's weird to kind of walk by her station now and not seeing any kind of plexiglass, and everything is off our conference room tables as well. So we're hoping that you're getting ready for life after pandemic. We know we're not totally out of it. We'll go through some of that stuff today, but Seth and I kind of wanted to give you an idea after the first half of the year, kind of seeing how things have went, what we kind of thought would happen, and then as we go towards the rest of 21 and some of the things that we're looking at going forward as well. So we call it the halftime report. We do it every year after half of the year is over, and so here we are in middle of July, almost to the end of July. So I've got some exciting news for you. In another month or so, I am going to be a grandparent. Oh my God, it's such a scary word. Usually most people refer to me as grandpa in the most unflattering endearment term. They're usually like, okay, grandpa, like another story, right? But this time, a little human being is going to be calling me grandpa. Pop is what I'd like to be called. But, from talking to a lot of you that are experts at having grandchildren already, you've already alerted me that that child's going to call me whatever they want to, and it's going to stick. So, but if I have my way, it's going to be Pop. So we're excited. Our oldest son got married last June, and he lives in Nashville with his bride Marina, and they're having a daughter sometime in the middle of August. So I may be down there for a little bit. I'll still be working from down there, helping them out. We all remember what it's like to have that first baby. You're in your 20s and you're trying to figure it all out. So my wife and I are going to be going down there helping them out. And Sally's chosen the term Gigi, so we'll see what the baby calls her as well. But so we're pumped. But I wanted you to know that as we kind of go through the rest of the summer, we're excited. The Murphy family is going to grow by one more. That means our Christmas card next year will have a baby in it, which is crazy. But I figured I'd start off with that good news, and don't worry, Seth will be here, the whole staff will be here, and I'll be on on calls every day. I'm still working from their home in Nashville, as we kind of help out with the little one. So I wanted to share the news with you before we get into the nitty gritty finances.
Yeah, so that's awesome. We're excited for Dan and the family. It's always fun when there's a baby around. So in this presentation, we're going to touch on some key points. We're going to start off with where we are with the pandemic. There's been some recent news and some changes with that. As much as we've trended positively this year, there are concerns out there about the Delta variant. We're going to talk about the state of the market. We're going to take a look at the deficit, and we're going to provide our outlook and some of the changes that we made. So when we take a look at where we were just about exactly a year ago, we were right around the 50 to 60 new cases a day and around 1,300 deaths per day. Now, that number is significant because those numbers have come down. So if we take a look at how it was just a few weeks ago, we were averaging around 6,600 to 7,000 new cases a day, which is significantly down. And the new deaths, you can see it dropped to 27 per day. That was just a few weeks ago. Where the concern starts to come in, and we've gotten a lot of questions from you all, it comes from the Delta variant that started, I believe it was India, and then spread to the UK.
Mm-hmm.
The reason the Delta variant is of a concern is it's just that much more transmissible. You can see here that it's, granted this is a wide number, 43 to 90% more transmissible. Fortunately, those that have gotten vaccinated do have a good immune response to it. You can see as far as hospitalization, if you've gotten your second dose, even with the Delta variant, you're 94% less likely to have to go into the hospital. So that's good news as far as that's concerned. But we are seeing an uptick in infections. So you can see even from a few weeks ago to, this is data as of yesterday morning, we had ticked back up to 35,000 new cases per day. And the deaths are up, although compared to last year, it's only 10% of what the actual daily deaths was. So it's clear as time has gone on, there's been more research, more time put into the treatment, and the vaccines are starting to have an effect. But this uptick is what you've seen causing some of the market volatility recently and having the CDC start to re-examine some of their guidelines.
And that's the key thing too. I'll just add to that, Seth. I mean, you're gonna start to hear talk about, obviously wearing masks, indoors again. They're already talking about that. I don't know how that's going to be in New York State. I mean, certainly as a state in this country, out of 50 states, of course, New York is really doing well with vaccinations. And so, not that everyone with vaccinations is totally immune from the Delta variant, but you figure when you look at the hospitalizations, 97% of the people that basically are being hospitalized right now because of the Delta variant are the unvaccinated, right? Kids, anyone that's chosen to not get a vaccination. So, although 75% of the people in New York are vaccinated, at least one dose, there's a lot of people that have chosen not to at this point. And, those people are the ones that are having issues more than the people that are vaccinated. Don't get me wrong. I mean, people with double vaccinations still can have some issues, but you're not seeing a lot of people wind up in the hospital or, God forbid, dying afterwards. So, that's the key thing. And a lot of the mandates that are going to come out now are going to be for both, for the vaccinated and unvaccinated. We'll still have to wear masks, but it's, again, not going to be as serious for the people that have already been vaccinated.
Yeah, and to kind of piggyback off the point that Dan just made, I mean, we saw the average daily death rate really come dramatically down from its height in January of 2021. That's one of the things that we've constantly been hearing and reading about, is just how quickly these things have changed. Because as long as it's felt since the beginning of the pandemic, it's only been 16, 17, 18 months at this point. That's a short period of time to be going from 3,000 daily deaths to averaging less than 400. So it shows that, certain things that they enacted did have an effect as far as the vaccine, as far as death rates, but also just since they're learning more and more about treatment, they're able to treat it better if it gets into those late stages and worst cases where they'd have to be hospitalized. So speaking to that, we actually hit a peak. At this point, if anyone wanted to go out and get a vaccine, they really can go anywhere. But we had hit a peak back in April of vaccinating right around 3 million people per day. Now that average is right around 1 million. So a third of the people are getting vaccinated per day. So that's something that it was expected because there was such a rush initially on, but we have seen it dramatically tick down. This slide is interesting. So a number of different states and organizations have offered incentives, like the Ohio Vax-A-Million is drawing. They're being offered free donuts. There's been sweepstakes for free groceries, gift cards, the Daytona 500, free Major League Baseball tickets, shopping discounts, paid time off. I had seen that they were doing something down in Brooklyn, which was shots for shots. So local bars would give you a free shot of something if you were to get your shot before you came into the bar. So
just what you want the next day.
Yeah.
After you're just trying to recover from COVID and people have had, some kind of issue after first and second shots. And now you're going to throw a shot on top of it,
Yeah, it's kind of a strange times that we're living in. I never would have thought that we'd have gotten to a point that we're providing these sort of incentives for a vaccine, but nothing about this pandemic has been normal or anticipated, to say the least.
Yeah.
So that leads us into our current economic situation. if we take a look at our equity performance year to date, stocks have done really well, and we kind of expected that. You can see the Dow Jones is up around 14% year to date. The S&P 500 up around 16. NASDAQ has lagged a little bit, the S&P at 14. But what we've really seen is the small and the mid cap. You can see the mid cap 400 up around 17 and the Russell 2000 up around 15 and a half. That's significant. We've been saying since the beginning or the middle of last year that we were expecting to see mid and small companies, when the recovery happens, outperform. And the reason for that really is they were hit hardest during the pandemic. They're the first to lay people off and they're the last to rehire them back. So they're really the ones that suffer the most and therefore would have the most legs to run on once the recovery started. Now, that being said, we've seen some volatility. We expect the stock market to continue to do well, but you could even see, even though the S&P is up 16% year to date, if you're seeing 4% drops like this suddenly, this is common coming out of a recession. You see volatile days. Even I think it was last week, Dan, that we saw the Dow drop 800 or 900 points and then it recovered back 700 points the very next day. This is typical of a post-recessionary period as far as market performance. You tend to see extreme good days and bad days grouped together like this, but overall an upward trend.
Yeah, I think to add on to that, when you look at some of the things that could be creeping in the fall of this year, if this, I don't think this Delta variant is going to go away very quickly, even though you haven't seen a lot of hospitalizations and therefore deaths at this point, even with the uptick in the amount of cases, that are being discovered each day. I think what's going to happen is, as you see more and more people, and if you start to have shutdowns again, that will cause some further volatility. I mean, certainly we know at least, we've got a little track record now with what happened last year during the pandemic. And although we're not expecting it to be that extreme, especially with people out there right now that are spending money in the economy, getting back to whatever that new normal is you're going to design for yourself. But we certainly think that it could be very foreseeable in the fall to have a lot more volatility even than what we've experienced already this year in 21.
So since they call it vaccine day, when we first started to see the vaccines rolling out, but when it was announced back on November 9th that we were going to start seeing vaccinations before the end of the year, it's basically what this chart is showing. And it does show, as far as the value in the core side, we have our large, mid, and small companies. We've seen these middle-sized companies and the small-sized companies have benefited more from that. Also, value stocks. When we talk growth versus value, typically value positions, which we own across the models, they're companies that have not necessarily participated in the uptick and we consider undervalued at this point. One of the things that's great is earnings growth really has been robust. Earnings recovered rapidly in the first quarter, growing by about 52%. Only 24% of growth was expected at the beginning of the quarter. And now 86% of companies reported actual earnings that were above their estimates. So overall, things have been going better than what the original estimates are. And when you take a look at the total returns across different asset classes, you can see we actually had owned gold last year in all of the portfolios, which we sold out of in August and in November. But fixed income and bonds has really underperformed. And we kind of expected that and modeled that at the beginning of the year. Conversely, commodities, and you all know that you're paying more at the pump and more at Lowe's and Home Depot for wood and those sorts of things. But the US really is leading the overall returns for the year. We've gotten a lot of questions about commodity prices and whether we think inflation is going to be temporary or permanent. We found this chart kind of striking that from the beginning of the year, if you look just at lumber prices to May 12th of this year, lumber was up 84%, which is kind of staggering. But since then, it's dropped back down another 56%, which is great. It's not back down to where it was, but we really believe that this is less of a supply issue and more of a supply chain issue. It's not like all of a sudden we ran out of trees here. It's just that it's costing more and there's less labor to be able to get it to market at prices that we were used to.
Yeah, I couldn't have said it any better. I mean, a lot of this is disruption. You've got to get people back to work. Like Seth said, go out there, cut the tree down, put it on a truck, ship it down to Home Depot, wherever your favorite lumber yard is, and that's going to take some time, you know, and not only just with lumber, but with a lot of other issues. You're seeing a lot of issues right now with chips, right? Everything has semiconductor chips and things in it, washers, dryers. I mean, everything is so complex now. It's not, you know, we were talking to somebody the other day that basically was saying that if you wanted to get a front, like a top load washer, which really is very bare bones, right? We used to open up the lid. There was a button in the back. If you push the button yourself, even with the lid open, it would keep turning, right? You know, there's no real brains to that. But these front load washers now, there's a lot of chips that are inside that washer. They got to detect, you know, whether it's unbalanced, whether there's a leak, whether it's locked. You know, there's issues like that. No more pushing the button and having the thing still turn. So that's just one example. Everything has chips in it. Vehicles, right? They have some vehicles that are coming out now. You've got to agree to basically take the vehicle, and once they get the chips sent, they will have you back in and put the chips in where they should be. You know, no safety things, of course, but you know, you're going to have some bells and whistles that don't work right now because there's a shortage of chips.
So right now, there's been a total of 5.3 trillion plus tax relief and fiscal stimulus. This is a lot. I mean, historically, we've really increased the debt, and we'll get into that on the next slide. But you can see state by state how much funding per person. You can see that New York State up here is spending some of the most money as far as fiscal stimulus that's been passed by Congress. But we do get questions about where we see the debt, and I wanted to make sure that we had some historical perspective. This is just as a percentage of GDP. We haven't seen this level as far as our debt to GDP since World War II. So that's a little staggering for us. You can see we rarely ran a federal budget surplus. We're basically always in debt. So that's a little concerning for us. But right now, because rates being so low, it's easier to put that debt on. But it is one of the things that we're going to keep an eye on going forward.
You know, to Seth's point, you know, I am a fiscal conservative. This scares the heck out of me to know that we are almost at $30 trillion of debt, and they're still talking about adding infrastructure and other packages on top of it. So it does make me nervous, but on the same token, you know, we've talked about, you know, clients that come in and ask about an overpriced, overvalued stock market right now. Prices are basically expensive right now because the earnings really in a lot of the industries were non-existent last year. But once we're all starting to get back out there and resume some activity, I don't care if it's just simple things like going back out to dinner in a restaurant, not outside but in a restaurant, to someone who's willing to take a cruise, right? There's a big difference between point A and point Z, right? But typically, as those things happen, you know, the economy will be in better shape, and then there'll be more funding and more tax revenue coming in for the government to hopefully, you know, pay down some of these things and make that, you know, that ratio, as Seth just pointed out, to be a lot lower. But it does make us nervous, no doubt about it. But fundamentally, we're not too concerned about the debt at this point.
So one of the things that we thought was going to happen this year, and it ended up coming to fruition. You could see that by the end of last year, right around here, we were under 1% for the 10-year Treasury. This is a large spike up. It went up to around 1.6. It's since come down a little bit to around 1.5, but we've essentially seen a 100% increase in the Treasury rate. And that's caused the fixed income markets to basically lag behind other markets this year. There's so many things that are tied to that 10-year Treasury that to see a 100% increase could put has put a lot of stress on the U.S. fixed income market.
Yeah, it's amazing when I look at that other line, Seth, for September of 2020. I mean, you're looking at a 10-year that was below 0.6. So when you look at, you know, maybe rates close to 1.7 at the peak in this year, you're talking about, you know, a huge increase, 200% increase from where it was. That's staggering to see that. And, you know, we kind of felt that that would be the case eventually. And we'll talk about that a little bit later when we talk about fixed income, where we are right now, and what we kind of forecasted. But that it is quite a difference.
Now we find this to be interesting. As much as there's a lot of different theories as far as people not going back to work, almost 20% of all Americans now are retired. And you can see through the pandemic here, when COVID arrived, there's just been a heightened increase of people just retiring. And I saw that alone with my children. My first son actually went through 3 pre-K teachers in the first month and a half of school in 2020 in the fall. So there's a lot of people that just hung up and said, we're done. Well, I'm not going to work through this. I have the means to retire. So this is the highest rate that we've seen in a very long time. And we're just going to have more people that are going to continue to retire. So this has been interesting. The amount of cash that's on hand, you can see that back in the recession back in 2008 and during the dot-com bubble back in 01, 02, those recessions, people ended up going a lot to cash. So they did the same thing at the beginning of this recession. It ticked down, but now it's starting to tick back up. We feel as though it's just, there are people that are still nervous on the sidelines that are not willing to put their money to work in the stock market. But we feel as though as things continue to open up and vaccine rates start to increase, that cash is actually going to come down. So the amount of questions that we get with regards to real estate, these statistics were pretty staggering. Home sales have gone through the roof since everything started happening during the pandemic. 5.8 million homes have sold. Existing home sales have increased 44.6 thousand. Median sales price has been $350,000, which is a 23% increase in actual real estate. So there's without a doubt a housing, I don't want to call it a bubble, but the increase in real estate prices has been staggering over the past 18 months.
Yeah, if you've seen this in, let's say beginning of this year till now for your reviews, we've pounded the table with this that, really through forbearance that people could have applied for not making a mortgage payment since last February. That program, unless it changes in the next month, will end at the end of August. And when that happens, there'll be some, we're not going to call it a bubble. It's not going to be a bubble. But typically you're going to have some people out there that put the house on the market. The difference between 2008, where people that all of a sudden couldn't make a mortgage payment because they didn't have a job, well, their houses were underwater because there's so much of a glut of real estate, too many sellers, not enough buyers. But in this case, real estate is doing very well. So if you get someone that still doesn't have a job after the pandemic has gone through now, and now at the end of August, forbearance will be over, they'll have to put the house on the market. Fortunately, they're going to walk away with a check in their pocket even after they pay the mortgage. But just the fact of taking some of those roughly 2 million homes right now that are in forbearance across the country, putting a portion of those, back onto the market and selling them will at least, make it so that it's not a bidding war every day with homes that are coming onto the market right now. If you've seen them, it's crazy in our area and all over the place, but especially in New York, certainly north of the city. People are putting their house on the market, and within a day or two, they're gone, usually for more money than what they put on for. So that will help the market, kind of solidify a little bit.
And that was a perfect segue, Dan. Around the major urban areas, as much as we've seen real estate increase in the suburbs, the actual cities of New York, Los Angeles, San Jose, Philadelphia, and Chicago have seen population declines. So you're seeing massive amounts of people getting out of these urban areas and going to suburban areas because everyone started to be able to work from home, work more remotely. So it's been interesting to see that there's actually been this population decline, which is adding to these home sales outside of the actual cities.
Yeah, and to piggyback off that, especially in New York, because I can't talk about the other areas, but with New York at the end of August, you're going to have a lot of turnovers of renters. I mean, renters at this point could not be evicted because of the moratorium that was in place. But with a certain amount of renters that have not made a mortgage payment, I mean, not made a rent payment, they can certainly petition the individual county or city that they're in. Let's say it's in Manhattan. The landlord and the actual, the renter can apply together for that loss of revenue for the actual owner of the apartment. But you're going to see a certain amount of people out there that leave, vacate, changeover of renters, and the issue that you're running into even in our local area. They had an article in the Poughkeepsie Journal this past week where they talked about, people eventually being evicted. And then basically at that point, there's just not a lot of apartments out there for people to switch into. So it's going to be a lot of first come, first serve. If you leave your apartment, you have to find something very quickly. From our clients, some that we've actually, tried to talk them into selling homes because they were going to get out of the area anyway. That's been very successful, but renting something in the local area while they make up their mind on where the next step is to, hang their hat, that's been difficult. So there's not a lot of vacancies out there. And that's going to become the issue, especially in our local area. So we're still keeping our eyes on that.
So one of the things that is trending a little bit in the more positive, although it's not at the number that we really want, unemployment really spiked up in April of 2020. Luckily, we've seen this downward trend, but we're still having employment issues. I mean, there's help wanted signs everywhere. And there's a number of theories for that, and that people don't really know exactly what's going on. But there may be pandemic fears still. There is also the theory that unemployment benefits are being too generous, whether you're receiving the state benefit and the $300 a week federal benefit. There's wage competition amongst employers. This is a big one, still needed at home. There's a number of maybe working parents that stopped working to take care of their children, and they're, instead of sending them to daycare because their daycare might have closed, they might still be at home taking care of their children. Reconsidering career options. Hiring challenges and skills gaps exists as far as the unemployment is concerned. So these are a couple of the theories that are out there as far as the employment shortage that we're seeing. As far as the supply chain bottlenecks and shortages, there's a shortage of materials. Dan was mentioning chips before. There's higher commodity prices, which we had mentioned with the lumber, transportation challenges, and labor issues. And you think about how many people, Dan uses the example all the time since we were talking about wood, how many stops a tree would have to make along the line just to end up at Home Depot, because you have the person that goes out and cuts the tree, you have someone that transports it, then you have the mill workers that mill it into your 2x4s, then you have to reload it back up onto a truck, then you have to have it delivered, then you have to have it stocked in a shelf at Home Depot. That's 8 to 10 different stops, most of which are probably around the minimum wage. So if those jobs aren't being filled and people aren't seeking them out, it's going to cause those higher commodity prices. One thing that is nice as far as investor sentiment, investors do remain bullish. So you could see historically, we are above the percentage that remain bullish on the market. And we feel that way as well. There's about just over 20% believe or have a bearish output, and there's around 33% that have a neutral outlook. So as far as the market is concerned, people are generally positive.
And that's the thing, people ask us all the time, why are we so bullish on the market? It's not just us. I mean, we've got a number of different partners out there that we use, good quality mutual fund companies, BlackRock, Vanguard, T. Rowe Price, John Hancock. We're independent. We can use a lot of different companies, but these are all companies that manage north of $1 trillion, and they're all bullish for the same reason, that every one of us, in let's say 99% of the cases, every one of us is going to spend more money over the next 365 days than we did the last 365 days. Even if you just go back out and do some basic things, going out to dinner, fixing up the house a little bit, resuming some kind of normal activity that you used to do before the pandemic, those things will translate into economic activity, and that will make the economy go. And therefore, in spite of debt, in spite of how much money the government borrows, it really has no bearing or very little bearing on what the stock market does, because the stock market works on earnings. And if earnings increase because people are spending more money, then stocks should be in really good shape. So that's why we're so bullish on the market going into 21 and beyond.
Yeah. And so on that note, we look at economic growth. So as far as GDP, the base case that they're forecasting is around 6.6%, with a worst case of around 5.5. Now, this worst case takes into account what we're seeing right now with vaccine mutates and new waves of the virus, maybe vaccine ineffectiveness, maybe the Fed will tighten sooner than expected, unemployment deterioration, maybe a stock market correction. So that's what this worst case scenario takes a look at as far as its projections. Still, a worst case scenario of 5.5% growth is still pretty decent growth. If you look at a best case scenario for 21, it would take into account more COVID cases falling through the second quarter, social distancing ending, passing some sort of infrastructure plan, and spending improving in the second quarter of 2021. So we're looking to see pretty significant growth between 6 to 7.5%. At least that's what's been forecasted. So what's been interesting, so this is a quote by a BlackRock managing director and portfolio manager, quote saying, in less than 1 year, the biggest risk to markets has flipped 180 degrees. Rather than worrying about a collapse in growth, today most investors worry about too much. In the process, treasury bonds have morphed into an efficient and reliable hedge to a source of risk, which is actually exactly what we've seen the beginning of this year. Treasuries and government bonds, because of interest rates, have really been some of the worst performers, which is kind of surprising with regards to fixed income. So in the beginning of 2020, we made some changes to the portfolios. We wanted to just take you back in time, back to February when we did another one of these recordings and some of the changes that we had made. So these are the actual slides back from February 12th. We had talked about a recent flurry of activity that we had reallocated the models. We reallocated everybody's model and changed the investment objectives where appropriate. The other things that we did is we bought small, mid, and emerging markets equity and focused on value as opposed to growth. So this is talking about overweighting the stocks, and we had a volatile year in 2020. So the reasoning behind the portfolio rebalance. But really the question is, how have these changes affected our models? When we take a look at asset class returns for this year, you can see that small and small value versus small growth, they've outperformed. So we have positions in the small and small value as well as large value. And just as we expected, you could see that fixed income really has lagged behind everything. One of the things that hasn't performed as well as we had hoped is right here, emerging market equity. It's not doing terribly, but it's not doing as well as we thought it was going to do. But we still think that there's opportunities in the emerging market equity, that we haven't gotten completely out of it, but we've trimmed our position back a little bit in it.
Fixed income is obviously key too. Sorry, Seth.
No, you're fine.
As rates go up, remember, every time rates go up, values come down in most bonds. And so, what Seth just went over the slide. I mean, basically going from a 0.6% 10-year treasury interest rate, let's say a year ago, less than a year ago, to a peak of 1.7, that's a huge increase. Yeah. Without any interest, increasing in your bank accounts, right? You're saying, boy, these guys are talking about rates going up and my bank account's not paying anything more than what they've been paying me since beginning of the year, which is hardly anything, right? But in this case, we knew the fixed income situation would start to have some cracks along the way, just because of the fact that you've really got nowhere to go but up in this case. If interest rates come back down again to where they were beginning, or let's say a year ago from now, when we were still in the pandemic and a recession, that means we went back into there, or something else drastically has changed very quickly. So, with interest rates climbing, you still have 30-year mortgage rates are below 2.5, 2.7. That's unbelievable. Think about how many times in your lifetime, even if you're still in the same house you've been in for 30, 40 years, think of your first mortgage rate you had. Think of how many times you refinanced along the way. I refinanced, 3 times in my 22 years in this house. I mean, I refinanced every time and chopped off some years. I went from a 30-year to a 15 to a 10, and every time I did it, rates were dropping. Anyone that's buying a home right now, they're never going to have to worry about refinancing ever, because those rates that they have right now will never be low like that, probably again. in our or their lifetime. So it's pretty interesting the difference. But bonds typically are the real stress point that we figured at the beginning of the year, would occur, and that's exactly what's happened.
So going forward, as we wrap things up, remember, we always base everything on the plan. So have faith in the plan that we've developed with you and for you. Always reach out if you have questions about anything, and be safe as we fully open up. Um, so that kind of concludes our halftime report. I'll kick it back over to Dan to kind of wrap us up here. But I just want to personally say thank you for your business. We appreciate it. I very much enjoy speaking with every one of you on a daily basis, and I hope everything's going well.
Great. And same for me. I mean, look, we still got another half a year to go. It's been a good first half of the year. We've got other issues that could stall the market or cause some more volatility. We certainly have never indicated to anyone that volatility is behind us, but the changes we've made to the portfolios this year so far have worked out pretty well. And everything is kind of going in one direction so far, which is great. But that's always a little bit of a worrisome situation as well. But we'll react to that, obviously not knee jerk wise, but knowing that the economy will still continue to do well because people are spending money. If all these other things kind of come into play, they talk about higher inflation coming back in. They talk about the Delta variant, causing more volatility, especially if we have a shutdown and the economy goes back, the opposite way again. Those could be issues that cause us to, pay attention to certain areas versus others. But we don't think there's any reason to panic. That's for sure going forward. So we'll keep you posted, and as we need to update these things, it's been a great first 6 months. So you probably haven't heard from us too much because everything has been going along pretty good. So, but as times become more volatile, we'll certainly reach out a lot more as well. But from all of us here at Murphy Wealth, we hope you have a great summer. We're here if you need us. Everyone has been back to work in the office with face-to-face appointments since last June. So we think it's a great way to be able to do that, to see each other face to face across the table, and not have any more Zoom meetings and things like that's kind of welcome from all of our standpoints as well. So if you have any questions, like Seth said, which I couldn't have put any better, just reach out to us and enjoy your summer. And I'll keep you posted about baby Murphy number 1. Take care. Thanks for joining us.